Welcome to Restaurant Deal Making Exposed, the only show that equips you with everything you need to know about restaurant transactions. In this show, we tell you all about how to make the sale or purchase of your restaurant not just possible, but successful. Now here are your hosts, ex-restaurateurs and seasoned brokers, Patrick Toda and Andy Mirabel.
Welcome back, everybody. This is episode 7 of Restaurant Deal Making Exposed. I'm Andy Mirabel. My esteemed colleague and friend and co-agent Patrick Toda with me here. And we have guest Dan Engel of Engel Accounting. I want to introduce Don a little bit here because I've known him for a very long time. He's a dear friend of mine, and we have been through a whole heck of a lot together on the business side too. So please meet Don Engel of engelaccounting.com, ENGELACOUNTING.com. Look him up. He's a great resource. Don spells his name D-A-N, but it's pronounced D-O-N. Don, which has been immensely amusing to everyone I've introduced him to over almost the last 20 years that I've known him and worked with him and referred him to clients. So thanks for that, Don. I appreciate that. Don is a restaurant accountant extraordinaire, as well as a father and devoted husband. He's been an accountant, auditor, controller for some recognizable accounting firms and brands. In 2007, Don was hired as a controller for Blowfish Sushi to Die For, whose flagship was in San Francisco. I started work for Blowfish Sushi in the early 2000s to help them expand their brand to San Jose, Hollywood, and even Auckland, New Zealand. Don and I worked hand in hand to tighten the reins of the company, owner spending, and as the company grew, this was not an easy task. Don is a tough cookie. He has a thick skin and always has his clients' dollars and cents at the forefront of his work. Don is not afraid to tell it how it is, in efforts to be most effective at his job. Don opened his own accounting firm nearly 10 years ago. When I left Blowfish Sushi to open my own restaurants, Don was the first person I spoke to about my budgets and, of course, working together. In addition to my own restaurants, Don has had the pleasure of working with some of the Bay Area's top restaurants. He has seen the good, the bad, and the downright ugly of restaurant books. And I can, from experience, say you're in great hands with Engel Accounting if they are handling your books. So let me back up a little bit about kind of what this episode is for our listeners here. We're calling this episode Cook the Books. And that's a tongue-in-cheek, okay? That's very tongue-in-cheek. This is no reference to criminal activity. Okay, so I don't know about you, Patrick and Don, but I've seen some downright wonky, bad, and fraudulent books in my days as a restaurateur and as a broker. And I'm not saying it's intentionally fraudulent, but I've seen stuff that could be determined as that. I've also seen some refreshingly organized, clean, and clear, transparent books. Today, we're going to share a discussion with Don of Engel Accounting regarding restaurant accounting in general, but we also hope to shed some light on the do's and don'ts of restaurant books. Given Patrick and I want to help our clients sell their businesses for the highest value, transparent and clean books are a must, and it'll help attract qualified and quality buyers. Patrick, you want to shed some insight on your background with some restaurant books?
Yeah. So, speaking from experience, for some of you guys out there know I used to work for Starbucks and Jamba Juice. And the really amazing thing about that was having your monthly reports and having them in a very timely manner. They're super accurate, and it was very easy to manage the businesses that I was managing for them. And when I went into business for myself, one of the hard adjustments was not having all the resources that these corporations have for you, and also having your accounting in a timely manner. So, that basically puts you at, if your accountant is not getting you things timely, having your, report 6 months later, it's really hard to manage your cost of goods and other costs of the business. So I cannot stress enough how important it is to have an accountant who understands the restaurant business and is, going to be on top of getting you all the things that you need in a very timely manner.
And that's where it entered Don, because he's that guy. So hi, Don.
Hi. I'm happy to be here. Andy, thank you for that introduction. That was really sweet. And yeah, so on that note, that's one of the things, honestly, we struggle with, because there is a lot going on, especially after COVID. The whole industry is just so turbulent, things coming in and out, restaurants opening and closing really quickly. All the money from the government that people, it kind of jacked up the business for a while, or injected the business with all kinds of energy, and that's kind of depleted now. And so with all this activity, we know at the forefront exactly what Patrick said, that we've got to get these financials out as quickly as possible. That said, sometimes it's 2-3 weeks into the next month where we're finally putting them together, knowing that's already too late. Like, you really need them in the first 10 days of the next month so that they're pertinent and you can work off of them and make decisions.
Just goes to speak, again, going back to margins, slim margins, and being able to pivot and make changes that are effective financially for restaurants are so hard to begin with. So if we're so far behind the ball with getting accurate P&Ls and stuff, it really puts an operator and owner at a disadvantage.
Yeah.
That's absolutely. Don, why is restaurant accounting so different from just normal accounting? Like if you have a good accountant who can do other things very well, but when it comes to restaurants, what makes it so much more difficult?
Great question. I think, Patrick, it's the sheer volume of transactions. So we're dealing with transactions happening in the bank on credit cards. And then we're also dealing with heavy accounts payable. So bills coming in on a weekly basis that have got to be entered and paid. On that specific note, on the AP, just recently within the last 4 years, I would say, we've also seen a really big shift where it used to be all the bills would come in scanned, or even people would mail them to us. We'd have actual paper and we would enter all the bills and we would pay all the bills. It was very centralized. It was very organized. Nowadays, bills are being transmitted in every direction. We have a couple scans, some are coming through emails directly through the vendor. Some are just electronic, so we get notifications that you have to click on a link and go to them to actually download the invoice. So it's become even more disorganized. On top of that, we have owners paying their own bills outside of the books. And so this has increased the volume and complication of the transactions. In another way that restaurant accounting is different is payroll is a little bit more complicated than in other industries. You're dealing with overtime, you're dealing with tips, and then these days, and we'll probably touch on this later too, surcharges, which made payroll really complicated.
You and I have war stories about that, Don, from the 2010 to about 2017, from SF and mandates and surcharges and all that jazz.
Yes.
We just did an episode on the new, law in effect that those have to be absolutely removed as of July 1st. Has that? How are your clients pivoting here?
They changed the law for restaurants. I don't know if you saw that, but I think they excluded restaurants after that.
Oh, well, aren't I misinformed? God, we can admit that.
They just announced it, actually. So, yeah.
Okay. I was on vacation, people. I'm sorry. Yeah.
We can all breathe a sigh of relief.
Okay, good.
Oh, Greg, do you remember I actually joined a large Zoom with a legislator, and he talked about how they were not able to change the original law that passed back in, I want to say, October or November of last year.
Mm-hmm.
And so what they did is they introduced a new bill. They rushed that through, and it made it onto the governor's desk, I think, by midnight on the 30th, and he signed it the next day. So it was really a
wow. That's amazing. I do remember, Don, with and I keep going back to SF mandates and healthcare and something we supported, but the implementation of the system was a train wreck for small businesses and restaurants, right? And I remember that we specifically opened an account to hold the funds per the requirements of the, mandate from the city, and we still got pinched for it. 100 restaurants got sued by the DA. It was just a nightmare. As a mom and pop owner, a Main Street restaurant, we're scratching our heads at trying to follow the rules, take care of our staff, have good books. And it just really, it just seems at every turn there's something new and makes it more complicated.
And that's exactly where this was going. All of my clients were freaking out because they have, either they're doing some surcharges and some tips, but there's like this mix of like additional little fees and stuff like that. Everybody's trying to maximize their intake without increasing menu prices because nobody wants to show that, your burger or your pizza is $30 or $40 actually.
Yeah, true. How many clients at one time does your firm manage comfortably? And I know you're always moving 100 miles an hour, so I know it's a lot, but give me an idea of that.
Right. There's always a balance of restaurants come and go. So adding a new restaurant client is a big ordeal and takes up a lot of our time. So right now I have 17 restaurant clients, which is, it's a lot. And I'm a small firm, so I have 4 employees, 2 very part-time. So we handle a lot of restaurant accounting for the size business. And
Are they mostly I call them mom and pop or Main Street.
Yep.
Many of them are not multi-unit across states and things like this, right?
That's right. Exactly. They are all mom and pop, seat of their pants kind of operations.
And how does that present problems for you? We kind of talked before we started recording as we were just tongue-in-cheek talking, but I think that was really fruitful what you were kind of saying. And we're not knocking the operators. It's hard to run a business, but it proposes challenges to you on the back end.
Yeah. So on the positive note, it lends itself to we have to do a lot more hand-holding. These operators don't have any kind of finance background or accounting knowledge. They don't, understand. And they have limited time to really focus on their bank account. They're trying to run a business, just like you said. So
I found it always very helpful to have, and I wish I would have gone into business this way, is one person is the operator on the floor operating the business, and the other person is handling the bookkeeping and like the liaison between the business and the accountant. And if you can have it set up that way, I highly suggest it, because having one person having to do both is just kind of a split personality that you just don't really want to get into when you're in the restaurant business, I think personally.
Now that you just said that, one of my more successful clients, it's exactly that setup. One of the partners, they both manage the business. One's a chef, one's kind of the manager, or I don't know what title you...
Kind of general manager-ish.
Yeah, exactly. Operator. And that's the person that I deal with, whereas the chef takes care of all of the kind of internal situation. Yeah.
Well, wasn't that what I did with you, Don? Why wasn't I more successful? I don't get it.
I mean, I knew accounting pretty well, but I had to be the operator and I had to be kind of doing all that stuff. Whereas, I wish I could have probably been more on the back end because I could have managed all that stuff, but I just didn't have the time. And then every time when you're off the floor to worry about, other things, you don't want to have to focus on that stuff. Your mind is somewhere else, basically.
Yeah. Andy, I would argue that you were extremely successful.
Wow.
Thank you. Gosh.
And practical. So what I'm seeing now is a bunch of businesses that are hanging on for dear life, and they're not making good decisions. They got these EIDL loans, the PPP loans, a lot of free or cheap money, and they didn't put it to good use. They just kind of lived off of it, sustained their business, and during that time where they had the money, they should have listened to me.
True.
So I'm screaming. I'm like, look, you're not profitable and nothing's changing. The trends show that things are going downhill rather quickly. Let's get some ideas now of perhaps closing the business and doing that in such a way so it's not just, well, what happens is people end up just, locking their door, walking out and wiping their hands. So that's where we are now.
I think I'm going to hijack a little bit of what Patrick may be asking next too, but which you're used to me doing now, Patrick, so it's okay. Anyways, you brought up infusions of government funds, and we are going to be talking about pandemic-related stuff until 2030, I promise you, on all these podcasts and conversations.
Probably.
Yeah. So you brought up the infusion of these funds and specifically, grants. Hey, you get money, don't need to pay it back. PPP, forgiven, kind of out of sight, out of mind at this point. But the EIDL is something that is a big hindrance in Patrick and my job to get to the finish line of these deals. And like you say, a lot of your clients, like you said, and a lot of our clients are distressed. They need to sell. But what they didn't take into consideration when they took these EIDL loans is that, wow, I'm taking $150,000, $250,000. I have somebody that took $1 million.
Yeah.
But their business is worth a fraction of that. So when they go, gosh, it's time for me to sell, they're still personally liable in order to pay this SBA loan down. And you cannot get around closing escrow or selling your business without paying this off. There are little caveats. We can assign it to a new buyer who's qualified. It's a low success rate and so on. I've been successful in doing a few of those. You can negotiate with the SBA if you have other assets, other locations and stuff, and recollateralize your loan by paying some of it down and assigning it to another location. But again, very rare and low success rate. I've done 2 of those. But the fact of the matter is these big chunks of money that have been infused into these businesses' bank accounts, we cannot cover that with the value of the business because the business was suffering for the last 5 years, 4 years, or whatever it may be. So it really has become a problem.
And also on top of that is a lot of the our clients, who had pulled out this money, talking about a 30-year loan at 3.7% interest. It's really good money. It's almost free money, right? And so a lot of them are like, I have the money, I just don't want to pay it back. I want to use it for my next. And I totally understand that. But however, for us to sell your business right now, we have to get this UCC1 taken off your business. And in order to do that, you're going to have to pay back that loan because the SBA just wants their money back.
Yeah. There was definitely a few ski boats and fancy cars bought with this money too. Okay.
I don't know anything about that.
That is, yeah, I'm seeing that a lot, not used in the best way. And so that's an interesting perspective. I only have one client who they had a rather small EIDL loan. I think it was in the neighborhood of about $50,000, something like that. They were able to negotiate a settlement for, I think, 10%. Really dropped down, and they weren't able to sell their business. They just closed.
So in that situation, I have seen in more of a desperate situation where it's like bankrupt this entity, then you can go through the negotiation process. It'll take many months. And that's very kudos to them for being able to do that. Because although it can happen, it's rare.
Yeah. It did take a year.
Wow. Yeah. That sounds like the SBA.
Yeah. All that free money seems to have been used up for the most part. And now restaurants are, I don't know, this is always a topic in almost every P&L meeting, like kind of rediscovering, a way forward. We're just putting everything on the table and asking ourselves, like, what's next? And in terms of restaurant accounting, all this free money during the pandemic was really difficult. We did a lot of PPP loan applications and things like that. And it took up a tremendous amount of time. So we put all our P&Ls aside and focused on getting this money for people. And then when it came to EIDL, what was the other? The employee retention credit.
ERC, right? It's a big one.
Yeah,
it's a big one.
Those were huge. And I really didn't want to mess it up for my clients. And we outsourced that work.
Oh, wow, you did. Yeah.
Yeah, there were many different consultants that picked this up because it was money for them. They took commissions based on how much they could get.
And they literally cut you a check on that credit. It's not deduction from your taxes. It's like you get a check from the government.
That's right. And they were big.
And funny for us, Patrick, and maybe some of our potential seller clients here that are wanting to consider selling their business. I remember I get tax returns still from 21, 22, 23, right? And you see these ERC infusions on there. And those are negative add backs for Patrick and I when we value your business. They do not apply to a new buyer. So I can't, although it may inflate your bottom line, we take that right out. So you can't have your cake and eat it too on this one.
And accountants like you, for whatever reason, some of them hide that money here and there, and you have to really dig through the tax returns to find out where it is. Sometimes it's the credit on labor, sometimes it's on other income, sometimes it's in the revenue. So you have to kind of dig around to find it. But normally, if that year looks a little higher than all the other years, something's kind of like off.
Yeah, I mean, if you're running 18% labor, there's a red flag there, right, Don?
Yes.
Yeah. And some people, and again, a good accounting practice, hopefully you can agree with me on this, Don, is I like to see ERC on the P&L. It needs to be there, right? It's just much more helpful and transparent.
Absolutely. Yeah, we put it all the way down to the bottom line. There's a little section for other income and other expenses, and that's where we put all the PPP forgiveness, the ERC, so it's well labeled and it's, kind of in your face so that you can do that work.
Did any of your clients get the RRF, the big grant that came out for very few people?
Oh, great. Yes, they did. And that was truly free money without much effort. I mean, you went online, it was a 1 or 2 page application, and next thing you know, you have a couple $100,000 in your bank account. I have just one client where I don't know what agency it is. I think it's the SBA or the IRS is doing I don't want to say it's a full audit, but they do have to submit how they used that grant money. And it's not pretty because, how did you put it, Andy? New car, water ski.
A couple ski boats and fancy cars. You know what I mean? So let's back up a little bit because maybe I was one of the few. I call my exit story from my beloved restaurant in San Francisco a bittersweet thing. it hurt at the time. It really was painful when I closed the restaurant in 2020 due to the pandemic and a bad landlord, and my whole neighborhood was just devastated because it was all tech and that was my business. So who's going to come to my restaurant after that? I did not take PPP. I did not apply for EIDL. I did not apply for grants. I opted to get the heck out because I didn't want the strings attached to it later. And so at hindsight, some of it, I'm like, God, I really probably could have got some money in my pocket, but to what end? I got out pretty cleanly, sort of.
Yes. So I think the word that described that period was uncertainty. If I remember, I think you closed like on COVID day, like March 20th. You're like, you called the landlord. You're like, I'm out.
Yeah. Well, our lease was coming to an end. We were trying to renegotiate a new term at a very high rental rate in San Francisco. And I had a little panic moment. And I think we made the right decision. Actually, I know we made the right decision because of how long it was vacant and what a good restaurateur is there now and still suffering.
Sometimes you got to know when to hold and when to fold, So I think you did the right thing, Andy.
I'm pretty stubborn, so I'm glad I happened to make that decision.
So at the time when you were closing, there was no such thing as PPP or EIDL or ERC. These things all came much later. And so the people who really benefited from those are the ones that, were doing okay during the pandemic. They were able to keep their doors open barely and hang on to the point where Congress made the decisions and let all this money out. Of all my clients, only one of them has made good decisions with that money and turned their business around. They, during the pandemic, they used that to expand their to-go business that they saw was the only way to stay open. And now coming out of the pandemic, they're using that money to, expand their business in terms of they made a private dining room and they're doing more events and things like that. Yeah.
That's good to see.
Yeah. Don, can I ask you a question? Can I jump to a different subject real quick?
Yes, please. Thank you for organizing me. I think the coffee is having its effect, so I'm a little
Oh, good. Can you explain the difference between accrual and cash basis? And then could you also talk about whether you're a component of a 13 period P&L and what that does for your accounting and all that stuff?
Yes. Okay. This is a fun topic for me. So
I thought you would get all.
Let me know if I bore you or if I far off tangent. So the only way to get a great P&L that will effectively let you make decisions is to be on a fully accrual basis as much as possible, right?
Yes.
So
Patrick
what that means is on an accrual basis, you are doing your darndest to line up all of your income and expenses during the same time period. So to illustrate that, let's talk about cash accounting. Cash accounting is strictly we take what's transpiring in the bank and we record it on the day that it cleared the bank. You're a restaurateur, you buy a keg of beer, it shows up on your restaurant on day 1. You don't pay for it until day 30, and that check doesn't clear until day 45. So on a cash accounting, you're paying for it about a month and a half later. That's when it's going to show up on your P&L. On accrual accounting, we take the bill. We enter the bill on the bill date. That's when it arrived at the restaurant. And boom, it hits your P&L on the delivery date when you're actually using the product and selling it. So yeah, on an accrual basis, let's see, what else? Payroll is another thing. So if we were recording it on a cash basis, it would be recorded on the day the employee received their check and cashed their check. And that is usually anywhere from 5 to 20 days, or actually in the restaurant business, you guys know, some servers never cash their check.
Yeah, exactly. Yeah. And then all of a sudden, in your slowest month, someone cashes $20,000 in checks. Yeah, it's fun.
That happens more often than you think. So that's the difference between cash and accrual accounting. And then with accrual accounting, we're able to look at it and say, okay, inventory. Sorry, that's another big aspect of accrual accounting. So you count your inventory at the end of the period. I'm going to circle the word. I'm going to write down period. So I come back to, you asked about 13 periods. You count your inventory at the end of the period. We reduce your COGS by that amount and then add them back the next period. And that tells us exactly the cost of the goods sold to the customer. And that and payroll are your two. We actually have a name for that. I don't know if it's a restaurant tradition, but perhaps you've heard prime cost. Prime cost is simply total cost of goods and total labor, payroll labor added together to give us prime cost. We use that as a metric.
Don, back in the day, we used to try to shoot for 50% prime cost. What do you think? Do you think we could still do that today?
Wait, I have to pick myself up.
Not even a chance. Not even a chance, Patrick. I scoff at what you just said.
That's so great. So I budget for right around 65% prime cost. For anybody listening, the lower your prime cost percentage, the better. And nobody's even attaining that.
And to be clear, we're not talking about any fixed costs whatsoever.
Right.
Rents, anything else. We're not talking about rent, insurance, any of the other things related to operating a business.
Right. Just the payroll and the cost of goods. And my clients aren't even achieving 65%. And so everybody's hanging on by a thread. We got to figure this out. The restaurant industry, somebody's got to figure this out. So let's see. Back on track. Well, okay, so that's accrual and cash accounting in a nutshell.
That was very clear. Thank you. I love that. That was great.
And then I wanted to touch on fiscal period accounting. So what we do to better compare this year to the previous year is we put people onto weekly periods. And so I came from a background of what we do. We keep it to 12 periods per year, but we divide each quarter up into 5-week period and 2 4-week periods. We mix that up a little bit just so that all the P&Ls aren't on the same day. And you'll hear this in the restaurant industry. Like I'll say, I got you guys on a 5-4-4 period basis or a 4-4-5 period basis. And so with the 5-week followed by 2 4-week periods, it's hard to compare period to period, but it lends itself really well to comparing against the previous year. And what I mean specifically is you're comparing in the restaurant industry, everything is cyclical on a weekly basis. Your Mondays and Tuesdays and Wednesdays are slower and they pick up, and Fridays and Saturdays are probably your biggest days. And that happens week after week. I have all my clients on bi-weekly payroll so that it lines up on a weekly basis. Sometimes we have to make an accrual to add in an extra week on the 5-week periods. But this allows us to really effectively compare to the previous year.
Now, with that, you get like some periods where there's 3 payrolls instead of 2. And so then 1 month looks like it's way more expensive, but over the year, it kind of balances out.
Right. If you were on a strict, maybe like a monthly basis, you were just looking at your P&L and you weren't doing any accruals, I think it's it's twice a year. You have 1 month where there were 3 payrolls that hit. And to avoid that, we put things on a weekly basis and we add in those accruals. The only time I've come across the 13 period is there's one vendor, Autochlor, in the Bay Area. And the reason we always flip out about this is they issue their rental invoices on their 13 period basis. And so it's not monthly. And so every once in a while on the P&L, you have 2 of these in one of our periods. And we're like, I don't know. I'm not going to accrue it.
Yeah. No, I remember those. We'd be like, wait a minute. Why is my dishwasher now 3% of sales versus 1? Right. I remember this, Don. Yes. Okay. So, Don, this is so informative. I love this. And it's very nostalgic hearing you talk like this because you not only are a restaurant, you understand the books so well, and a restaurant accountant, like you do, whether you like it or not, help strategize, help these folks really do what's best for their business. And I remember and appreciate that so very much.
Yeah.
I guess one of the things we really want to touch on is some of the just core good and bad practices.
Uh-huh.
You take on new clients. I'm curious to know how far back you have to dig into their books, tax returns, whatever it may be, to really get an understanding of the client you're taking on and how to move forward in a smart direction with them. That's something I'm really curious about. And if there's just some really bad things, you've found specific things that you could be like, don't do this. Don't do this on your books.
God, I love these questions. So you guys, once again, stop me if I go off too long. So not really to toot my own horn, but just I have never received books from a previous bookkeeper that were in good shape ever. And what it comes down to is the balance sheet work, which, okay, let me take a step back. We have a bunch of accounts. We call it the chart of accounts. It's just a list of all the accounts. And that's kind of divided up into two sections. We have what's called the balance sheet and the income statement. Another name for the income statement is profit and loss, P&L. Same thing, exactly. So you might hear that terminology thrown around by accountants. And on the balance sheet, we have accounts that carry a balance. The checking account is a great one to think about. You don't really look at the checking account and say, you look at an expense account and you say, how much did I spend on janitors, or how much did I spend on beer last year? And the balance sheet just holds a balance. So you ask, what's the balance of my checking account, right? How much money do I have in the bank? And that's all the accounts on the balance sheet. And most bookkeepers don't come from a background where they ever did any balance sheet work, and they don't really understand what needs to go on there versus the P&L, what you're allowed to put on there. And when we get the books, we have to go through and dig up all the garbage that landed on the balance sheet and deal with it. And usually this comes in the form of, which probably comes right back to you guys, fixed assets.
Okay. So if I went out and buy a wine fridge for $10,000, Don, I would ask you, is that going to hit my P&L this month, or are we putting that on the balance sheet?
Thank you. Perfect example. And most bookkeepers don't understand when they're supposed to put an item, just like you described, on the balance sheet.
As a capital expense, correct?
Yes.
Yeah.
And I think, do you guys use the fixed assets when valuating a business? It's an asset, right?
To an extent, we do, yes.
Yeah. And so that's really important. And small stuff. So I bought what did we say, a wine fridge?
$10,000 wine fridge, yes.
Yeah. But maybe they just needed a little tiny wine fridge for at the bars that they could reach into. And it only cost $700. That doesn't really meet the threshold that we use, that the IRS recommends. And so we do throw that on the P&L.
It'd be a bar supply at this point, or a restaurant supply on the P&L. Okay, got it.
That also comes in the form of, you have this line item on your balance sheet that just says loan, and it's got 324,000, some random number in it. What does that represent? And the owners turn to you and they shrug and they say, I have no idea. And I'm like, well, do you recall owing anybody any money? No. And you're like, okay.
Why is it here?
Yeah, why is it here? And then we end up having a meeting with the CPA, the tax person. It's on the tax return. Nobody knows what it is. And we strategize. It has to go somewhere. It has to come off. And so that has tax implications too, because that loan turns into income to the business and you have to pay tax on it.
Because it's not owed. It's nothing that is owed. It's instant income, and you need to. Yeah, that's interesting.
Exactly.
Wow.
So
sounds like some journal entries are coming into play here.
Yeah.
Yes. A journal entry is the background.
Taking me back here, man.
Of every transaction on the books. And you're right. It's kind of like our sledgehammer.
Yeah.
So it is not delicate, and so in bookkeeping, we have a bunch of different types of transactions. There's deposits, there's expenses and things like that. And the journal entry is our way of going like, this doesn't fit any other type of transaction. Wham! There we go. We just adjusted it out. And you'll hear the term write-off a lot. CPAs and bookkeepers use this term when they don't know what to do with a number.
I seem to remember using this a lot for a company I won't rename, but I feel like we talked about journal entries just about twice a week for 5 or 6 years.
I had this experience. I had a bad accountant and I had to come over to a good accountant, and they had to clean up all of the bad stuff and do all the journal entries and all the things that you're saying. It's like a bad dream that I'm reliving right now.
Right. So great question. So what's the takeaway is try to work with your bookkeeper and get an understanding of the balance sheet. Hopefully that sticks with some people and review the balance sheet, maybe not as often as the P&L, but definitely a few times per year to make sure no garbage has settled or made its way to the balance sheet.
Well, you heard it first from Don, you guys. Like every quarter, dig into that balance sheet, right?
Yes.
It's what you got to do.
Yeah. You've got to look at your numbers on a regular basis. There's so much money to be saved if you just really familiarize yourself with your P&L, get really comfortable with it. The more you can look at it, the more you're going to be a successful business owner. I can't tell you this enough.
Yeah.
Andy, you asked a really good question too about how far back. So we can only go as far back as the most recent tax return. Now, for some clients, that might be 2 years old. They just haven't gotten around for whatever reason. Things got complicated during COVID. There's actually some pretty decent reasons for people going like, I filed the extension, but I still didn't make it on time. We have all these complications. We couldn't get it together. So we can go back as far as the most recent tax return.
That's surprising to me.
Yeah.
So like what if you went back to the second, 2 years ago or...
You would have to refile.
Yeah, you'd have to refile. Do you ever come into that?
Doesn't that risk you getting audited? Doesn't that give you a red flag to get audited if you refile your tax return?
I don't think it's a red flag, and it happens a lot. It's amending a return. And for a CPA, it's not a big deal at all. But Patrick, just like you mentioned, it freaks out my clients and it happens when like this loan situation that I was talking about. So the CPA recommended going back to the previous year and doing the amendment there so that it doesn't affect the current year, and thought it was worthwhile because it was such a large number. So you would work with your CPA and determine if it's worth amending your return. It's not as big of a deal as you think. The IRS does this all the time for both business. It is a big deal in terms of that you're getting new K1s for all your partners, and all of the partners will have to amend their personal returns. So it is kind of a big deal. It is not a red flag to the IRS. They're not like, ooh, an amended return, let's go audit.
Okay, great. That's good to know. Cool.
So we go back to, in most cases, it's just to the beginning of the year. We'll go back and we'll redo the books this year to date. I've on occasion gotten books that are in decent shape where we've been able to pick it up where the bookkeeper left off. But usually I look at them and they're not really structured for a restaurant. You have maybe 10 accounts in alphabetical order and you're like, I need more accounts. Andy, I don't know if see, a little sidetrack. Okay. Our P&Ls from Engel Accounting are pretty detailed. The chart of accounts is long. It takes a little bit of time to get used to, but we found it very effective to organize the P&L so you have your income section at the very top, you have followed by your cost of goods, and then you have your expenses divided up into 4 major sections. You have your labor, you have controllable expenses, non-controllable expenses, and occupancy. So when I get books from other bookkeepers, they're not versed in restaurant accounting specifically, and they just have kind of a handful of accounts that they use to categorize stuff. And it's not enough to let us do great analysis and consulting work.
That also speaks to what Patrick and I, want to see with books, right, Patrick? Mm-hmm. We need more detail because when we recast EBITDA or seller discretionary earnings or whatever it may be, to have this detail, to know what to back out, add back to the bottom line or not, it's very helpful. So when they're too general and categories are too general, it leaves a lot to question. And that also leaves a lot to question when I share those books with a potential buyer. So it doesn't help us. So I think that a good practice is what you're saying, is to be a little more detailed, have these categories that we can break out and it's clearer to see everything.
Yeah. And for sellers out there, having that detail and us being able to back out as much as possible, which then, increases your SDE or your net income, then we can get you a better valuation on your business and sell for a lot more. So it's really important to have that clarity and transparency into your numbers.
Oh, that's such a great point. I hadn't thought about it from your perspective, but yeah, it's absolutely true. So with a more detailed P&L, you're able to see those numbers more clearly and do your valuation much better. Yeah.
Do you put, I have to ask this because it always kind of drives me crazy, is I see people put sales tax in as income and then they pull it out as an expense. I mean, shouldn't that just hit the balance sheet as a liability? Does it really need to be, I understand that it kind of zeroes itself out, but how do you handle that?
So, wow. That was the definition of speechless. Yes. So you nailed it. Sales tax is a balance sheet situation.
Thank you.
And through, it should never hit a P&L. I have seen that on occasion and gone, just you got to scratch your head and go, what is this person thinking? Does zero itself out, but not for, it's on a 30-day cycle for most restaurants where you're paying monthly. So you're taking in money daily, paying monthly. It would just destroy a P&L. I don't know how you could. Yeah.
Don, this is kind of a selfish question because it's always on my mind. The variety of ways that owners pay themselves. And I don't want to go too far into this, but I just I cringe when someone says, oh, I do cash draw. That doesn't help me. I don't see it anywhere unless I dig into your personal bank accounts and this sort of stuff. Stop doing that, people. Do not do cash draws. But what if, payroll versus guaranteed payment? You and I have ping-ponged on that a lot because I know I paid myself guaranteed payments. A lot of owners run themselves through payroll, which I've also seen a lot of benefits to.
Or a management fee. Have you ever you see management fee? Like, what's the benefit of having a management fee versus something else, or just taking a distribution, I guess? Yeah.
Man, just fantastic.
A lot, sorry.
This episode could be 2 hours, I'm sure.
Yes, we need 2 episodes on this. This is great. Yeah.
Let me break it down in such a way that it's very clear if I can. I'm going to try and organize my thoughts because there are very simple rules for the 3 things you mentioned. So there's payroll, or 3 or 4 things. There's distributions, there's guaranteed payments, and there's management fees. So let's start with payroll. So here's the rule. If you're an owner and your business is an S Corp, it has to be a corporation. And I've never worked with a restaurant that is a C Corp. They're almost exclusively S Corps. If that is your situation, you have to be on payroll. Now, you can, on occasion, take a distribution in an S Corp as well. But your payroll has to be, the IRS would like to see it so that if you're a manager, what do most managers get paid, in your area?
Yeah. It needs to be somewhat similar.
Yeah, it needs to be similar. It needs to be close. I think the test is they want to see it about 90% of what the market rate is for, like, if you're in San Francisco and general managers are making $100,000 or something like that, you should pay yourself around 90 for the year. That's what they want to see. And, there's a lot of gray area there. You could probably get away with reducing it. There is a tax advantage to distributing money. So a lot of people, in an S Corp setting, once again, try to reduce their payroll so they can make quarterly distributions. That money is taxed at a different rate. And at that point, please refer to your CPA.
Yeah.
I usually don't give advice on that.
Smart, Don. Smart there. I like that.
That's payroll. The word distribution is also kind of known as a cash draw or an owner's draw. People use that as well. Basically, it's taking money from the entity and not running it through payroll. And that's recorded on the balance sheet. That's why, Andy, you alluded to, you don't see it. So you're like, well, how much did you take home? I don't know. All I see is the balance on the balance sheet. It doesn't tell me how much you took, though, for the year.
But it's part of the net profit, right? I mean,
that's right. As far as the IRS is concerned, you're just taking profits, so there's no room for it on the P&L, which brings us to the next type of payment, and that's a guaranteed payment. So a guaranteed payment happens in an LLC setting, or if you are a single member LLC, also you would take guaranteed payments. Guaranteed payments are, as far as tax are concerned, exactly like distributions. However, it allows the owner to put the money on the P&L. It needs to be labeled as a guaranteed payment. There's no payroll taxes withheld from it. It's just a straight check, or, in modern day ages, just transferring money to your personal account.
Would that show up on the tax return as the owner compensation?
Yeah, yes. When the CPA gets the P&L and they see the word guaranteed payment, they know they have to pull that off. It's similar to your add back.
So there's no payroll tax associated with that? Is that what you're telling me?
There are, so flows through to the personal taxes of the individual. It shows up on their T1 as they receive this much in guaranteed payments. I don't know if there's a separate box for distributions and guaranteed payments. I'd have to check that out, but yes. So an LLC owner takes guaranteed payments and pays all of the payroll taxes, the self-employment taxes on their personal tax return. That's the distinction between the LLC and a S Corp. The last type of payment that you talked about are management fees. And we see that, and this is becoming more and more popular when owners set up another corporation to hold, usually it's just themselves. They'll set up an S Corp just for themselves, and it's set up as a management entity for their business. So even in a mom and pop setting, I've seen this where you have the restaurant is an LLC. It has maybe multiple partners, and the owner their selves puts together a small corporation, S Corp, just for themselves, where they pay themselves payroll and they collect management fees from the company. I think this is becoming more popular. I don't know the tax benefits from, but I think it is somehow very tax beneficial to the person. That's where you'll see management fees.
That's amazing. I mean, you broke down 4 different styles of payment. Patrick's right. We're going to have volume 2 of this, Don. So we'll call you in 2025 and we'll do this again.
You might be a regular for sure.
Yeah, no, this is, but it really tickles me to talk through this stuff. I miss restaurant books. And of course, Patrick, you and I read books daily from different clients, leads, and other things. But this has just been super fruitful. I hope the listeners absolutely think so too. I love it. Thank you so much, Don. We're going to probably wrap up here, but we do have one bonus question for you I have to ask. And I'm actually excited because I've been failing at this. We've been getting the same damn answer from these restaurateurs. So
that was a great buildup. I can't wait.
Yeah, you're going to be different. All right, Don, what would you do if you had to work, but you didn't need the money?
Wait. In what world do I have to work, but I don't need the money?
In my world, okay? In my world, Don, okay? In our world of this podcast, this is our curveball.
Your spouse is making sure that you have to work.
Yeah.
So that's you have to do that, but let's say you didn't need the money.
Yeah.
And so, okay, sorry, I was still registering that concept. It was still like landing, and I missed the question.
What would you do if you did have to work, some sort of job, profession, career, whatever it may be, but it wasn't about the money, you didn't need the money, so you could make $1 a year, but it would make you happy?
You know, I was just speaking with a potential new client. He hasn't come on board yet, and I think they may be in, I shouldn't really even allude to them, but they may be in that situation, and I think for me, it would take me a moment to find my passion. So I landed in this line of work because in my head, I was a rock star. I was waiting tables and playing bass in a band. And then at age 30, realized I needed to get a career going and needed to make a move. And just happened upon bookkeeping, which led me in turn to restaurant accounting because I had the waiting tables background. And I was picked up by a firm that did specifically restaurant accounting. And so here I am. And I think if that were my situation, which I love, it would take a moment, sit on a mountain and meditate and go, what do I really want to do in life? And I, so busy like everybody is with, whatever life, kids, the works, that I haven't had a moment to reflect on it. It's such a great question. What would I do?
Pick up the bass guitar, Don.
Yeah.
Rock star.
Go back to being a rock star.
All right. Well, that means that this is open-ended question for next time. I promise you that. So, Don, I wholeheartedly think you're a fantastic human. I've loved knowing you for over 2 decades now and working with you. So thank you for all you do. Thank you for joining us today. Everybody, have a good bookkeeper. Be clean about your books, be transparent about your books, and be consistent about your books. This is some of the things we're taking, and focus on your balance sheet, right? So
Many thanks to both of you. This is fantastic. Great experience. Love talking to you.
Thank you, Patrick. You want to lead us out on what's happening next?
Yeah, Don, thank you very much. It's been one of our longer episodes, but I found it to be very interesting. So thank you very much. And for our guests, join us next time for episode 8. We will be joined by Vlad Kud, a longtime friend and owner of Butter Bar and Buzzworks in San Francisco. Vlad, an expert in the bar, nightlife, and entertainment scene, will share his insights and expertise with us. I believe his knowledge will be valuable and enjoyable for everyone. And thank you, everybody, for joining us again.
Thank you.
Thank you.
If you enjoyed today's show and don't want to worry about missing an episode, you can follow the show wherever you listen to your podcasts. And if you found today's episode interesting or useful, please share it with someone you think would benefit and consider leaving a rating and review.
Reviews help restaurant owners or buyers just like you discover this podcast and benefit from the important topics covered in the episodes. Your opinion matters to us as a listener. So feel free to leave topic suggestions and feedback for us, as we will use these to tailor the episodes to you and help you get the most out of listening.
Thank you all for listening to this week's episode of Restaurant Deal Making Exposed. If you're considering selling your business and would like a free consultation, reach out to Patrick and Andy at therestaurantsalesbroker.com or visit www.therestaurantsalesbroker.com to learn more.